Okay, welcome everyone. Let's will start our today lesson will be to LO2 learning two. Is only my name Anjum Sathar. Please, if you have any question, drop me email anjum@ukversity.co.uk. I'll try my best to get back to you as soon as possible. So we'll start with LO2. Let's please. Anybody any question before starting? No, okay. So during last lesson, we discussed about LO1, which is about investment appraisal. We went through payback period, NPV, IIR, ARR, accounting rate of return. We discussed about weighted average cost of capital, and we discussed uh, dividend methods, dividend evaluation methods as well. Okay, so today lesson will go through be able to advise on managing financial risk. Risk, what is meant by risk? Risk is mean probability or the chance of happening. So risk can be measured in terms of probability, the chance. So advise the hedging instrument. Hedging means the protecting against the foreign currency. One of the risk, in the business, in the financial world, the exchange rate always carry on fluctuating. So we need to be make sure we manage the risk, because that's the biggest risk can be for the businesses. Analyze the factor affecting the granting the credit to organization. So if you want to grant the credit, what factors affect organizations, and advise the organization management of gearing. Gearing is mean high gear, high risk, the gearing ratio that we can look around as well. Okay, 2.1, use the hedging instrument to manage the currency risk. Risk is mean probability, hedging mean protection against the foreign currency. So we have a treasury department responsibility, cash liquidity management. Cash is the liquid, cash and liquidity management. A couple of you learn about the current asset and the current liability. So current asset divided by current mean that asset is liquid or liquidity ratio. So that's, which is most liquid because the inventory stock is less liquid. So we're looking at the things which we can convert into cash, or cash itself is a liquid. Okay, then we look the currency management. We need to be manage the currency. We can deal, sometime in different currency, because like you heard, don't put all egg in one basket. That can be look around. Cash management, to manage the cash. So we trade receivable days and trade payable days. We receiving money quicker from our customer, and we paying suppliers later. Capital market and funding, corporate financial management, risk management, treasury operations and control, investment management, and corporate finance. These all the part of treasury responsibility. So also known as the exchange rate risk, the currency risk. Foreign currency occur when where the cross-border operation involve more than one currency. It is financial risk which can be posed due to unexpected changes in the exchange rate between the countries that can be huge impact on the cost. So types of the foreign currency risk can be transaction occur when the company buy the product and the services in different currencies as receivable in different currency, their operating currency. So translation risk is occur when the company's financial statement reporting affected by the exchange rate volatilities, which is mean quite volatile. It can fluctuate. So economic risk occur when the volatilities in the exchange rate market can be cause changes in the market value of the company, because if the exchange rate lower, then of course the value of the currency and then affect the company. Transaction risk occur when the companies buy in product and services in different currencies or have receivable in different currencies than their operating currency. Since the payable and the receivable are dominated in different currency, the exchange rate and any station which we can look around nation of the transaction, and which we can look around the date of the settlement and make the changes due to the volatility of the market. This can cause, again, the loss of the company depending on the direction of the movement of the exchange and thus pose the risk to the company. Okay, and then the translation rates, which we can look around, occur when the company's financial statement reporting affected the exchange rate volatility. Yes, the large multinational companies generally present in many countries, like a Unilever, like Procter and Gamble, Nestle, like Nike, then the subsidiary reporting and financial statement and currency in their countries which is operate. The parent companies generate, the reports in the consolidated financial. And so please, when we produce the consolidated statement, parent company and subsidiary, if you own the 20, if you own the shares for 51, 49 or more percent, more than 49%, so we can call that your subsidiary company. And if you own it less than 49, 20 to 49%, we call it associate company. So that's, we put there, we have a control on their board management and all in the rules which we can look around the foreign currency and different subsidiaries and domestic currency. This can be huge, impact on the company's balance sheet, income statement, and can ultimately, affect the stock price of the company. So type of the foreign risk can be exchange risk, economic risk. A company face, economic risk when the volatilities in the economic exchange rate market can be caused, the changes in the market value of the company. It is basically represent, the effect of the exchange rate in the movement of the revenue, which we can, and the company with ultimately affect, the future operating cash flows and the company and its present value. That's, which we need to be look around. Okay, then we can look around managing the foreign exchange rate. The transactional risk can be managed, by hedging the strategies such as forward, future options, and other financial instruments. Transaction risk is a difficult to hedge, control and involve the balance sheet item, long-term asset like such as the property, plant, equipment, and then the liability, which is difficult to hedge due to the long-term nature. And it is the economic risk, difficult to hedge as it's complicated and quantify the risk in hedge. So foreign currency, again, the dollar, like you will see, the currency base market maker buyers and the base and the market sellers and the base. So that's, can be derivative. And the derivative is the instrument, which we use the contract, but the whose value, that are the characteristics are derived from those other asset instrument called underlay. So interest rate, foreign exchange rate, credit, equities, and quantities, derivative, fixing the instrument sales and the purchase of the fixed price or the forward or the fixed and the float interest rate, which we can option the premium paid and the flexibility to enjoy the price rise and the fall and no obligation to buy and sell and fix or float and no risk, taken on the principal and the forward contract. Often, shutter in to the just, forward and in the contract agreement to buy or sell, the asset, specific price on the specific date in the future. So since the forward contract refer to the underlying the asset that will be delivered, the specific, the date and consider the type of derivative, we can look around the party who's buy a forward, contract entering into the long position. And that's, these are the key points which we need to be look around. If the price of underlying assets increase in the long run, the company a financial position. If the underlying asset price decrease, the short the benefit. So forward contract, for example, your money currently in the US dollar, however, 1 year's time, you need to make the purchase amount, this and the spot rate, which is mean today rate 1.1. And however, you don't want to be the cash tied up in fact foreign exchange and you want to be guarantee this exchange rate in a 1 year's time. However, you enter into the forward contract against £1.13 against the dollar and euros, and at that date, of maturity, the spot is 1.16. However, the much of the money you saved by entering into the contract. So we can look around the exchange rate we are supposed to pay in euros And if you had not entered into the contract, the maturity, you have to pay 116. So if you hedge it, so there is 116, and so we can 3,000 can be better off. So in a line, the factor they're affecting the granting the credit. Credit is mean giving the credit facility, evaluation, and the approval of the credit, which we can look around these, in, and that's quite crucial, which we need to be look around the assessment abilities and willing of borrower and the return of the money. Typically, the small businesses must see the credit approval and obtain the funds from the lenders, investors, vendors, and also grant the credit approval their instrument. Factor affecting the credit risk define the amount of the risk the business is willing to accept. Does the lender have the financial resources to support the transaction? Credit term decide how much credit and the banks are willing to expend and how long they can afford, wait payments and requiring, the certain percentage down, minimizing the risk. Credit policies a process when extending the credit from the application submission and all the, costs. So factor affecting the granting credit probabilities of the default is entry the issue the debt, institutes such as the corporate bonds, hires, which is at the deposits and the higher, the interest rate and the higher required down payments on the loan. Lower given default extent to the loss in the financial institution, collateral of the loans, and legal abilities to pursue and defaulted the fund. Exposed, which we can assessment of the total loss exposure the lenders in exposed at that point in time. The factor affecting the grounding credit risk define the risk is the probability of the chance of occurring the lender and the financial support and the creditor decide how the credit of the bank is willing to extend and how long they can afford to pay the payment. Requiring the certain percentage of the down can be minimize the credit policy, the process granting the credit based on the application. We can do the ratios and we can do assess. We can look around various factors. The type of the business, fast moving goods, preferred as the compared to the high inventory businesses and start business, less preferred compared to the established business and financial performance, revenue and the profitability and the balance sheet as a outstanding loan, default payments and working capital collateral, which we can look around and we can make. Then advise organization on management of gearing. Gearing is the financial gearing is referred to the related the proportion of the debt and the equity. High gear, high risk, like if you're driving in a high gear, it's a high risk. So we can debt divided by equity, that ratio we can calculate it, or we can look around debt divided by non-current liability plus uh, equity divided by. We can, because sometimes we borrow money for the long term. So buying the asset, that can be increase your capital. So net asset is equal to your capital as we learn the accounting equation. Huh? Cannot raise the sufficient cash from the investor to meet the requirement. The company want to increase return on equity and use the debt, to buy the back shares and investment. Okay, which we can look around the capital expenditure requirements, what we have. We can look around why debt financing is cheaper than the equity, lower risk tax relief on the interest. So we might, expect increase the proportion of the debt, finance and the good to be ideal and will reduce the weighted average cost of capital. Increase the level of debt may be more risky and the finance risk, which traditionally theories, if you contrast to the optimal level of gearing weighted average cost of capital, we have there is a Miller and Maliani concept, which is mean debt is a cheaper than equity because the debt and the interest you paid, which we can claim. Weighted average cost of trading, which we need to be calculate debt and proportion of the equity need to be divided. See the bankruptcy risk worries equity and we hold we can calculate, that cost of equity, cost of debt, and then we can calculate and we can represent via graph. The static theory, which is about the tax should tax shield, which is deducted of the corporate interest in the payment on the debt, which is cheaper. That financial will be increased, from value and reduction in cost, the present value of the cost of financial distress and the bankruptcy and increase, agency cost as well, which can be static theory is they argue that the firm's static position adjusts, their current level of gearing, achieved target, and about the target debt ratio and the firm is not optimal and distress, agency costs exceed the benefit. Then, of course, below the target, that is the ratios still increase the value of the firm, managing the values and the between the debt is greater than the cost of associated the debt, the firm increase its debt. So Pickering theory, which is stated the firm have the preferred hierarchy of the financial decision, internally generated from debt and then new issues equity. So implications of this is the value which we can look around. Some project of the undertaking, if the funded internally and the company has less cash, higher the gearing will be more prone under invest. And if the firm follow the picking theory, the gearing ratio result in a series of incremental decisions, not the target ratios in mind. And equity issues depends on the degree of the information. Okay, compromise approach is the exactly the long run target of the gearing ratio, while the target decision must be governed by the static trade-off, and when close the target and Pickering will dedicate the source of which we can look around the fund. Okay, guys. So today we discuss about the risk. We discuss about granting credit, and we discuss about the sources of fund and how we can manage the risk through gearing and the debt is cheaper than equity, and normally we use the debt financing because the only interest we paid on the debt is the expense for the business. But if on the equity, the dividend we pay to the shareholders after the tax, after paying the tax, and dividend mean the return on their investment, and that's not a fix, and the shareholders expect more higher rate of return as a dividend compared to the interest. Thanks for attending to the session. Next lesson we'll go through our LO3 and we'll look an assignment brief of the following lesson. And if you have any question, drop me email anjum@university.co.uk. Thank you. Have a lovely week. Thanks. Bye bye.